Is the rally starting to fizzle out? That's the question on everyone's mind after today's price action, which can only be described as milk toast. And when the market doesn't know what to do, it reverts back to its old habits. Buy tech and don't look back. And while we did see smaller names outperform large, diving into the S&P 500, we saw the Magnificent Seven outperform the broader market. But are tech stocks right now, specifically the Magnificent Seven, the best bet as earnings comes into focus? Earnings needs to beat expectations by a lot to justify current valuations, and so far we've seen nothing but very mixed results. So today we're going to cover earnings from head to toe, looking at some of the big names that reported earnings here today, and I'll be telling you what it means for price action this week, this month, and for the rest of 2024. We also need to look at this chart right here and why it's so important for the rally we're seeing in small caps. And what does this mean? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a very mixed day for large caps. We saw outperformance here in industrials and some of the bigger names, Amazon, Google, Meta, Apple, Microsoft, but not the same action in semiconductors except for Broadcom. They were up 2.2%, but that might change. We did get a couple of earnings here in the after hours and the results were pretty good. I'm talking about Texas Instruments and a couple of other news events. However, for large caps, it was a very mixed day across the board. There wasn't really much to say. I think what a lot of the market was doing was just buying time into the earnings reports of Google, of Tesla, of a lot of the market that we get over the next 2 to 3 weeks. We were just seeing some mild rotation in and out of certain names, certain sectors. There wasn't much to go off besides the fact that when the market really doesn't do anything, you simply just buy what works. And right now what works are these big names, or because they are growing earnings, particularly Google. We're going to talk about the earnings report a little later on in the video, and that resulted in almost every sector here in the red except financials and materials. The worst performing sector being energy, down 1.6%. Utilities, discretionary technology, it was mixed. There was nothing really to go off. It's a very mixed day today here in the large names, but very bullish in the smaller cap names. Small cap, growth, core, and value all up 1.1, 1.2%. We saw mild upbeat action in mid caps, but really it was a day for smalls, outperforming mid caps and large caps by a pretty wide margin. And when you actually dive into the details, it was pretty obvious to see why the small caps moved the way they did. 10-year yields were actually pretty much flat on the day, up 0.02%. The 2-year yield, however, actually fell 0.62%. Smaller cap names tend to have shorter duration debt that tends to be floating rate, whereas larger cap names tend to have longer duration debt that's fixed. We also saw the dollar did firm up today, up 0.15%. Now, small caps aren't really affected by a stronger dollar because most of their revenues are domestic, whereas the larger cap names, stuff like the S&P 500, these tech names, are highly tied to movements in the dollar. So that was the main reason why we saw small cap outperformance. We saw shorter duration yields fall, the dollar rise that impacted large caps, plus the overall rotation we are seeing in the smaller names saw the IWM up 1.06% against the S&P 500, which was down 0.16%, the Nasdaq 100 down 0.35%, and the equal weight also down 0.35%. So really it was a day for just these smaller names like mid caps up 0.2%, S&P 600 up 0.72%, and the IWM up 1.06%. So really truly was a day for just smaller size over larger names, and mid caps did see mild outperformance on that side as well. Now let's dive into the S&P 500. We saw some very clear things. So we know our key levels, guys. We look at this every single day, the gamma chart. Now a couple of things we do need to note. Number one, the gamma flip zone was at 5,600 yesterday. It actually did move down. The S&P 500 now at 55 means we're slightly above the gamma flip. We are in positive gamma. That means we buy dips sell rips to the 5750 area. Despite what the market actually looks like right now, we have to follow the process, and in positive gamma we buy dips to the call resistance. In negative gamma we sell weakness, buy strength to the put support zone. We follow the process, and that's what we do right now. Now we can flip back into negative gamma tomorrow, assuming the Asia session and the Europe session is a bit of a dumpster fire, which I think is going to be strong. Generally speaking, if small caps are strong, mid caps are strong, Asia, Europe, the Australasian session tends to be fairly strong because those geographies are just technically smaller and mid cap names relative to the US market. So I think we should see a strong Europe session, a strong Asia session, and that should keep the S&P 500 flat overnight. If we do remain flat and open tomorrow above the 55, we buy dips, sell rips to 57.50, and there's 200 points from here to here, and that's very good alpha that we can generate into the August OPEX. But if we do fall below the gamma flip, we saw the put support zone is now at 5300, previously was at 5500, which means if we do go below the gamma flip, there is a long way down and we could see some extended sell side, coupled with the fact that seasonally we are in a very weak period of the year. From pretty much now, August, late July, August into October, we tend to see weakness in stocks, particularly large cap stocks, and especially in years that have been fairly bullish. Now, I think a way to hedge is simply just holding smaller names, the IWM, something like mid caps, SP600, maybe even the CAF index, if you are looking to generate some alpha in this period. But all of this will just be a dip buying opportunity because I do think we're going higher in the S&P 500. I don't think we've eclipsed the high for the year. I think we could easily see 58, 5900 very, very easily in the S&P 500. So for now, guys, buy dips, sell rips to the 5700 unless we actually get below the 55 area or the 55.50 area, in which case we're selling weakness all the way to this level right here. Diving into some S&P 500 stats, yesterday we looked at this right here, the S&P 500 performance in August after a positive May to July. Today we're going to look at the monthly performance when the trailing quarter is positive. So pretty much you have here July, the last 3 months, June, May, April. If they're positive, what is the average return in July, August, September, October, and so on every single month? And very, very interesting data. In years when we've had positive trailing quarters and bullish years, essentially, we do see August have an average return that is negative. Same with median. September, slightly negative, although pretty much flat, 0.09%, negative 0.12%. And then in October, which on average is negative, but on the median side is actually positive. So we are entering a period where we can actually see volatility after a stellar run we've had in the S&P 500. So if we do actually start to see quite a lot of volatility, particularly in the S&P 500, I'm not talking about small caps or mid caps, more the larger names, that is actually kind of normal in bullish years, particularly in August and September, but especially here in August. And all in all, we do have to remain constructively bullish because when we have a strong first half, we normally do see further gains in the second half of the year. You can see in years when we've had rallies in the first half greater than 5%, 10%, and 15%, the second half of the year normally returns very robust returns, 7.1, 7.7, and 4.1% on average, data since 1950. So let's talk about earnings. We had a very, very mixed day of earnings. Spotify reported earnings very good. They were up like 12% on the day. UPS down 12%. They were a bit of a dumpster fire. GE, they beat on the top line and bottom line, raised guidance. They were up 5% because they raised guidance. Coke actually raised its guidance too. They had a fairly all right day. They were up 1%, 0.8% for the day. There were a couple of other names I really want to focus on. Zion's Bancorp, it's not on this list. It was a regional bank. It jumped 6% after reporting better profits for the last quarter than expected. This actually really helped the Russell 2000 and regional banks in light today. Another company that's not on here, a small cap company, Sherwin-Williams, they were up like 6%. It's felt the pain of higher rates because it's highly tied to the housing market. However, they forecast better profits, especially in growth in paint demand for new residential customers. which is really, really good. So, they actually are seeing the rate cuts are going to tangibly affect the housing market and do so very, very quickly. Visa had very mixed results, but I didn't dive into it in any significant detail because I hold Visa. It was something I was going to look at a little later. Texas Instruments was actually up 4%. The market really liked their earnings. Enphase Energy was also up 4% in the after hours. So very mixed results here, some winners, some losers. But let's actually talk about Alphabet and Tesla, or Google and Tesla. Now, Google actually had a double beat. They beat on EPS, beat on sales, 1.89 versus 1.85 on sales of 84.7 billion. That's ex-TAC, by the way. And it was actually a very solid quarter. They were fluctuating between positive and negative here in the after hours. At one point, they were down like 1%. One point, they were up like nearly 2%. But you know what? I thought it was an extremely good quarter, a very solid quarter. Every business segment met or beat expectations except YouTube revenue. And this was actually the first cloud quarter with more than $10 billion worth of revenue. So a very solid quarter here from Alphabet. Price to perfection, that's why it didn't really move, but great earnings. Great earnings nonetheless. This is like a 28% increase in EPS year over year, 14% on the revenue side. Very, very solid quarter. Now, Tesla earnings, very mixed earnings. I don't really know what to think of it, but the market did sell off here, down 1.85%, but we have seen a bit of a rebound here in the after hours. But they actually missed on EPS 0.52 against 0.62. That was the expectation, but they actually did beat on sales, 25.5 billion versus 24 billion. However, there were a couple of concerning things and a couple of really good things. Number one, management said volume growth may be lower in 2024 as new products and next-gen vehicles launch. But the market kind of expected this. No vehicle launch ever goes according to plan, especially according to the exact timeline management puts out in the first place. 20% of gross profits came from regulatory credits versus 12% in Q1. Huge red flag, which is why we actually saw the sales side a little bit upbeat here, but that didn't translate to margin accretive value for shareholders in earnings per share. 740 million came in energy profits, and by the way, energy storage revenue is expected to outpace automotive revenue growth. The energy segment, which now makes up 16% of Tesla's revenues, is actually really ramping up and a big growing part of the segment. I think if you're buying Tesla, you need to look at this business segment now because it's actually significant. It's actually a significant portion of Tesla's revenue. All in all, I have very mixed earnings. I don't know what to think of it. The market probably does like these earnings. Why? Because the stock is up like 80% in the last 2 months, and to actually see a movement of only 1.85% after missing on EPS but beating revenue and seeing this little red flag right here, it probably goes to show that stock is probably fairly valued where it is right now. I personally still think it's overvalued, but the market doesn't think so, and that's all that really matters. Now, diving into the earnings scorecard, we have some very interesting data here. This is BofA's data, and they actually source their data from FactSet. So we're going to see where they believe we stand for second quarter earnings. This is blended earnings growth. Now, we're not going to look at the quarter over quarter figures. We're going to look at the earnings and sales figures year over year. Now, BofA have 8.2% as the earnings figure, earnings growth in the S&P 500 so far this quarter, 4.9% on the sales side. So a little bit more upbeat here on the sales side is what BofA and FactSet believe compared to my data. And then in terms of S&P 500 companies beating consensus expectations, they have 71 companies have reported, 73 beating EPS expectations. That's a big number. 59% beating sales expectations and only 51% beating sales and EPS. So a lot of companies seem to be finding a ton of operating leverage, but not so much on the sales side. That's why we're seeing results below the historical average. The historical average is 66%, but still very early days. And I think after this week, next week, we get a much more clear picture as to where we stand with these figures right here. There's a lot of expectations on earnings, and if we go ahead and miss these, things can get dicey for the S&P 500, but particularly for small caps as well. This is small cap earnings expectations and large cap earnings expectations since 2022. And what we've recently seen is a huge down move here in small cap earnings expectations. To actually see this can bring volatility in smalls. We'll have to see if the market does brush it off. I am bullish, but I am just outlining risks we are seeing. And that is why I've always championed small cap quality, because 41% of companies in the Russell 2000 have negative earnings. And this has actually risen in a zero rate environment since the early 2000s. We saw this accelerated year in 2020 when rates were pretty much at zero, and this figure remains very elevated relative to history. And this is part of the reason why the Russell 2000 is often seen as a value index and mean reverts a lot, just because earnings are far less stable than something like the S&P 500. But that is simply not stopping the market right now, because US small cap funds saw the second largest weekly inflow ever, going back to as far as 07-08, even eclipsing what we saw in 2020, 21, 22 here during the COVID bubble and the everything bubble. So funds, retail, and institutions are all bullish on small caps, trying to generate some alpha. And here's some absolutely crazy stats from Tom Lee's fund strat. In bull markets, when the Russell 2000 outperforms the S&P 500 by greater than 8% over a 10-day rolling period, which is very rare by the way, every single time the Russell 2000 is higher 1 and 3 months in the future to the tune of about 5 to 8% respectively, but it gets absolutely wild 6 months, 12 months later. Look at the average return ex bear markets: 14% for the Russell 2000, 32%, median 16% and 14%, the win ratio 100%. That's a crazy hit rate, crazy stats. So the fund flows we're seeing in the Russell 2000 is something we definitely need to pay attention to, and you want to be long because we are about to go on a wild ride. Now let's talk about the macro, and probably the biggest uncertainty with regards to the macro has to be the US election, not just because we could see a new president, because the Democratic Party is in absolute shambles. They had to switch up a new nominee after Joe Biden. It's looking like it's going to be Harris. And according to pollsters Real Clear Politics, Harris and Biden polled similarly versus Trump over the past week. So it seems that the most likely outcome is a Trump victory, Republican sweep, and that's probably how we should play our cards. Now, with regards to policy, the US economy is driven by about 66% consumption. Now, a lot has been made of the consumer pulling back in recent months. That has been a big narrative, but the data simply doesn't support that. Retail sales do not suggest the consumer is pulling back. This is actually one of the reasons why I remain bullish throughout 2023, 2024. We have a very data-driven approach on this channel. We look at the data, we follow the data. The data is telling us that retail sales is not pulling back. In fact, it's moving healthily up according to trend. And because of the strong retail sales we got last week, Goldman actually increased their GDP forecast to 2.3% quarter over quarter. And in light of that, they actually see continued disinflation in both CPI and core PCE in the upcoming reports. Here's a little note they released from their trade desk. They say, we forecast a 0.2 versus 0.1% consensus increase in core PCE prices in June. While CPI prices rose to 0.06% in June, core PCE is likely to be higher than usual compared to the core CPI because of the strength in categories that receive more weight in PCE, and because residual seasonality is likely to boost core PCE by about 5 basis points. We raise our second quarter GDP tracking estimate by 0.5 percentage points to 2.3% versus 1.9% consensus. Last week on strong retail sales and industrial production reports, core nominal retail sales increased 0.9% in June, with April and May spending levels both revised up. Industrial production increased 0.6% in June. Auto assemblies increased to an elevated 11.6 million. Our mid-year temperature check on GDP growth points to slightly stronger 2.5% pace in the second half 2024. Consumer spending should keep growing robustly, supported by solid real income growth powered by a strong labor market and positive wealth effects. Business investment should slow because the factory building boom has peaked. High frequency indicators point to a near-term softening in housing, but state budgets point to a modest slowdown in government spending. The rise in the unemployment rate so far looks unusually benign, and we still see recession risk as low. We have noted in past research that in US history, when the unemployment rate has risen a little, it has eventually risen a lot and been accompanied by a recession. The unemployment rate has now risen 0.07 percentage points from the bottom, 0.5 percentage points on a 3-month average basis. But it's also important to understand the economic mechanism behind the historical pattern, namely a vicious circle where job and income loss led laid-off workers to reduce their spending, causing affected businesses to then lay off more workers who then had to reduce their spending. The recent increase in the unemployment rate looks unusually benign because it is not followed in that pattern. In fact, the layoff rate remains extremely low. The unemployment rate has instead risen because net job growth, while still high, did not keep up with unusual rapid growth of labor supply driven by the immigration surge. This means that workers' incomes and spending hasn't fallen. It has just risen at a pace as far above trend as it could have. With immigration now slowing, we think the US economy will only need to create 150,000 jobs a month going forward to keep the unemployment rate stable. Close to our forecast for the rest of the year, our best guess is that therefore the labor market will stabilize on its own. Even so, job growth has not stopped slowing yet with the inflation problem solved. We see little reason to take any risk. For this and other reasons, we see a solid rationale for cutting as early as July, though we do not expect the FOMC to cut until September. Wow, that is crazy. So Goldman do actually see a way that we can actually cut in July. Interesting. Because the economic mechanism that leads to recession when the unemployment rate rises is not playing out, we still see recession risk as low. Moreover, the Fed now has 525 basis points worth of room to cut and no reason to hesitate if it needs to push back against further labor market deterioration. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.